Welcome to Stock Markets with KR. Stock Markets with KR में आपका स्वागत है. Today we have a very special guest who's none other than Anshul Gupta, the co-founder of Wint Wealth. You might have heard of Wint Wealth, and they've been killing it recently in the investing space. They're a fintech company backed by Zerodha and others, and just really doing amazing stuff to make sure that finance is accessible to us retailers also. So with that, Anshul, how are you? How's it going?
Going well, Kunal. Thanks for having me on the podcast. Pleasure being here.
Thanks for coming.
No, pleasure being here.
Yeah, great. So, as I understand, Wint Wealth does a lot of covered bonds and MLDs and such. So, I myself was not really that familiar with them. So, if you could just introduce what they are, ekdam novice ke point of view se.
Sure. So, before explaining what products Wint Wealth is doing, let me take 2 minutes to give some color on investment landscape in India.
Sure.
And particularly for retail investors.
Right.
So if you look at the options which are available for any individual investor, there are broadly two options, and both lie on the extreme ends of investment options. One is your low risk, low return debt products like FDs and debt mutual funds, which are giving returns between 4 to 7%. The other option I have as an individual investor are like equity related instruments, be it equity mutual funds, equity options, futures, stocks, etc. And here the risk return profile is between 12 to 20%. So these two are like a pretty extreme investment choices, which I have as an individual investor. But that should not be the case. So that's the vacuum that we are trying to fill at Wint Wealth, wherein we are offering a third investment option to an individual investor, which are our Wint Wealth products, wherein returns are closer to equity segment. The returns at our platform are between 9 to 11%. At the same time, the underlying is still a fixed income instrument, which means it's a debt product and not an equity product.
Right.
So now returns are higher than FDs and debt mutual funds, but risks are lower than equity. So both risk return profile is somewhere between equity and debt. So we started, I think our first deal happened in December of last year. It was a 10 crore asset. Subsequently, we got our second asset in March, which was again a 20 crore asset. And post that, we have seen a good traction. In May, we did a 20 crore asset. In this month, we did a 15 crore asset. And we have a good pipeline of around 50 odd crore worth of assets for coming July.
Nice. That's great. So all of these assets that you mentioned, they are these, debt-based securities that are giving equivalent, almost near returns to equities.
Right. So our punchline would be these instruments have returns closer to equity segment, but risk lower than equity, yet still higher than FDs. So risk is somewhere between FDs and equities.
Okay. So basically, returns are a little high, risk is a little low. And it's not really, many people have that notion ki yaar ekdam risk-free paisa chahiye. This is not that, but it gives you more value for, the risk that you are taking. Is that?
Yes. Like you said, risk is definitely higher than FDs, but returns are also commensurate. So while FDs are giving you 4 to 6%, here returns are between 9 to 11%.
Right. So, and this is being made possible using these covered bonds and MLDs and these instruments.
Right. So these so if you look, you might be wondering what a covered bond is, right? It's a pretty technical term. No one in India has heard about them. So these are like fairly popular instruments in some of the advanced economies like European countries, US, etc. In India, the first covered bond happened in January of 2019, wherein a mutual fund invested in the first covered bond. Subsequently, the product has become quite popular in the debt markets amongst mutual funds, ultra HNIs, family offices, banks, etc. The same product now we are trying to democratize, that folks like you and me should also have access to these covered bonds. These are like regular bonds, but with a second layer of security. Now, a regular bond is nothing but a loan essentially, which you are giving to a company. So when a company issues a regular secured bond, they're essentially borrowing money from the bond investor. Now, but if the company goes bankrupt, they default, the money gets stuck. Like the company goes into IBC, bankruptcy proceedings, etc. And recovery might take a lot of time. So that's where the covered bonds come in. In a covered bond, when a company borrows money, they give an additional level of security to the investors. These securities can be gold loans, vehicle loans, housing loans, etc. Imagine the borrower is a NBFC, a non-banking finance company. Guys like Muthoot, Manappuram, Chola, Bajaj, etc. So what their regular business is, they borrow money from the market and lend to their retail borrowers. And this borrowing can be for purchase of gold, for purchase of vehicle, for purchase of property, and so on.
Right.
Now the money which is due from these retail investors is given as additional security in a covered bond instrument. So that tomorrow, even if the NBFC defaults, the money coming from these gold loans, vehicle loans, property loans will still go to the covered bond investor.
Okay.
That way, a covered bond investor has dual recourse. One is on the borrower, the NBFC who is issuing the bond. In the scenario that NBFC goes bankrupt, the money coming from the underlying security of gold loans, vehicle loans, etc. will go to the covered bond investor.
Okay, understood. Right. So basically, it's at the risk of possibly using the wrong word. It's like an insurance that you have, that additional, money that is coming in. So in case something happens, that is always there.
Right.
Okay.
So that's why we say it's a dual recourse instrument.
Right.
One recourse is on the borrower, second on the underlying collateral.
Right. Understood. And let's say everything goes smoothly. Let's say the first party, everything is fine. Then what happens to the second sort of structure?
Alright, like as long as borrower is paying on time, well and good. The money coming from the second structure goes back to the NBFC only.
Okay.
The second layer steps in only if the NBFC has defaulted. That's when money coming from the underlying security starts flowing to the investors.
Right. Okay.
So if you, I think if I were to take an example, like we know about Diwan housing, right? A lot of investors had invested in their bonds.
Right.
Now, imagine like Diwan housings and borrowers to whom Diwan housing had given money. They are paying on time, but that money is lying in bankruptcy proceedings of Diwan housing. That's why Diwan housing's secured NCD investors are not getting any payment.
Okay.
But had it been a covered bond, the money coming from the end borrowers of Diwan housing would have started going to the covered bond investors.
Okay.
So that's like the beauty of a covered bond over a regular bond.
Okay. And this is something similar to MLDs, or are they very different in terms of structure?
Right. So MLD is I would say, a special category of a bond. When we talk about covered MLDs, in that what we do is in a regular bond, we have a fixed coupon. Let's say the bond is issued at 9%. So each month, NBFC will pay 9% coupon. That money will go to the bond investor, and the taxation will be as per the income slab of the investor. Which means if you are in 30% tax bracket, you will be paying 30% tax on the 9% coupon that you are earning.
Okay.
In a MLD, the coupon is linked to an index. Index can be Sensex, Nifty, etc.
Okay.
Now, since your coupon is linked to a equity index, the taxation becomes almost at par with equities.
All right.
Which means if you hold the covered bond for more than a year, the taxation will be as per LTCG, which means almost 10%.
Acha.
So that's like the taxation benefit of a MLD over a regular bond.
Right. So the return characteristics of MLDs and covered bonds, are they similar, return and risk?
Yeah, so a covered bond can be a regular bond or a MLD. So the only difference is whether the payout is fixed or is linked to a index. Otherwise, the risk return profile remains the same.
Okay. So would it be right to say that a covered bond is like a fixed rate coupon, and this is just a floating rate coupon version of that?
Yeah, MLD, even in MLD, so there are normally two scenarios. Like if Sensex today is 50,000, If it goes below 10,000, then the coupon changes. Otherwise, coupon remains the same.
Okay.
And it's a very improbable, unlikely scenario that Sensex will go below 10,000 in a 1 to 2 year kind of time period.
Right.
So it's like notional linkage to Sensex, which is done for all practical purpose. It's also a fixed coupon instrument only.
Acha, right, understood. So, by the way, for our viewers and listeners, coupon, in case you aren't aware of coupon is basically the interest that you will be getting. So 9% that Anshul is saying, that is like our 9% interest rate that we will be earning on that. So just wanted to make sure that everyone's aware. So those were the basics of covered bonds and MLDs. Now, once we start to dig deeper, we start to think that acha, this is good, but how is this actually being made possible? So what are the logistics behind covered bonds and MLDs? If you could just share with us that.
Yeah, sure. So it's a I would say slightly complicated product to manufacture, because these are rated by rating agencies. You'll find it surprising, these are also listed on Bombay Stock Exchange.
Oh.
So like equities get listed, even these covered bonds get listed on BSE. Oh. So a lot of work goes behind the scenes in manufacturing these covered bonds. We get a lot of complaints from our customers that you're not bringing assets at a regular frequency. And I think the main bottleneck is the complication involved in manufacturing these covered bonds.
Right.
So first step is like identifying the right NBFC to partner with. In India, like you would be knowing, there are more than 500 NBFCs. Now, choosing the right NBFC who is worthy enough of bringing to our investors is the first process.
Right.
And the process of identifying involves doing diligence, going through their systems, processes, operations, etc. Once the NBFC has been identified, second step is cherry picking what pool of collateral loans need to be included in our transaction. Because that's my second recourse. If NBFC goes bankrupt, the pool will pay me back the money. So the second step is cherry picking right kind of loans which will be eligible and are worthy enough to be included in the transaction. Once the pool and NBFC has been identified, next step is getting the execution done. This will involve speaking with the rating agencies, getting their feedback on the structure to tighten the structure, getting the desired rating, etc.
Right.
And the documentation, it's a very tedious process. So it involves almost 500 pages of documentation.
Oh.
And yeah, once the documentation etc. is there, last step will be to get the listing done, which again can take almost 1 to 2 weeks.
Oh, okay.
So the sequence of steps will be identify the NBFC, identify the pool, get it rated, get the document signed, and do the listing.
Okay, understood. So, just for the listeners and viewers, in case you weren't aware, all of these products are still, done in conjunction with these rating agencies and with the regulatory authorities. It is not like some person is just, sitting and doing all these things. They are properly structured and formalized, right?
Right.
Perfect.
And once the listing is done, we invest in the transaction from our balance sheet.
Okay.
So let's say if we bring a 20 crore asset, that means Wint Wealth has invested in the transaction from its own money, using its own money.
Okay.
And once the investment is done, then we sell it down to our investors in the secondary market, essentially.
Okay. So essentially, let's say you're doing a 20 crore issue. First, the entire issue is subscribed by Wint Wealth and then it is sold.
Yes.
Okay.
Yes.
Okay. So is that, sorry, you were saying something?
Yeah, because like NBFC will, to do a transaction with the NBFC, they will require money upfront. They can't say that, okay, you give us 1 lakh rupee on day 1, 2 lakh rupee on day 2 and so on. They expect entire 20 crore on day 1. So we invest in the transaction using our capital and then gradually that is sold down to our investors.
Okay. So that is basically how you are able to bring this something which is normally just for HNIs and UHNIs down to people like us, right?
Right. Because HNIs have that capital. 10 HNIs can come together and invest in that 20 crore transaction.
Right.
But it's very difficult to pull in money from 2,000 investors to do a transaction. So to enable this access, we step in, we invest in the transaction, and then we sell it down to our customers.
Okay. So essentially the first risk that is there is on Wint Wealth. And then, once, because obviously if you guys are risking your own money, you have to do the due diligence, and also that first money is yours, and then, people subscribed via you guys, right?
Right. But once, let's say our customers have bought the covered bond units from us, then the recourse is only on NBFC and the pool.
Yeah. Okay.
So it's like I purchased something, but then I've sold it to our investors.
Okay.
So then the risk of underlying NBFC and pool lies with the investors.
Right. So then you guys are just, the medium for this exchange to actually take place instead of being the counterparty.
Yes, yes. And that's also intentional because we don't want our investors to take counterparty risk on Wint Wealth.
Right. Right.
So it should not be if tomorrow Wint Wealth were not there, their money is stuck. No, that's absolutely not the case. The coupon which NBFC pays flows from the NBFC to a SEBI empaneled trustee and from trustee directly to the investors.
Okay.
So money is not even routed via Wint Wealth.
Oh.
NBFC pays to trustee, trustee pays to those 2,000 investors who have purchased the units from Wint Wealth.
Okay, understood. So, like this product, are there any other products that you've seen which are only really available to HNIs and UHNIs that you feel need to be brought down to the retail level very soon?
Yeah. So even in like debt markets, there are various products which as of now are available only to HNIs and institutions. Covered bond is one such product. We also did something called as securitization.
Okay.
So that is another product which is available only to HNIs and ultra HNIs and institutions. That is also something which we are looking to democratize. So along with the covered bonds, in future we might have securitization transactions also.
Right.
Other than debt market, in real estate, you will see a lot of these commercial buildings are available only to ultra HNIs, the yields, etc. are good. There are few startups who are looking to democratize that market also. So that again, I think can be further democratized.
Okay.
So a lot of such options are there in the market, which a normal person like you and me cannot take part in.
Okay. So basically using the same, framework that you guys have, that first you would be the subscribers and then you would, sell it on in the secondary market. That entire framework might just, help democratize a broader array of products. Correct?
Right. It's happening in other markets. So there is no reason why India should be left behind. In US, you will see startups who invest even in paintings, wines, even like a very high branded pair of shoes whose value appreciate over time. So these alternate asset classes will eventually become democratized, even in India also.
Okay, that's very interesting. That's very interesting. It's very fun to see how the landscape of investing has changed. And from our traditional, typical in the olden days, at least in India, most of the investments were either done in like post offices or FDs and such, to now having these really almost unthinkable asset classes. So do you foresee any such change happening, major change happening?
Yeah, so I think tech has been a great enabler. So the reason we are able to do this now is because we have the benefits of tech with us, which wasn't available to earlier generation.
Right.
Therein, a person would have to physically go and sell the product, market the product, which is not economically feasible to do at a mass scale, and that too at a small ticket size.
Correct.
But with tech, this can be templatized, productized. Now we have a Wint platform which we have built, and investors can directly approach the platform rather than us reaching out to the 10,000 investors.
Okay.
So that I think has been a great enabler, and same framework we are looking to replicate in other asset classes also. So I think it's only a matter of time that retail investors will have a lot more options to invest in, other than Papa Ki FD or equity mutual funds.
Right. But then possibly by that time, HNIs and UHNIs will have an even crazier investment class, possibly.
Which is a good thing, which ultimately will trickle down to retail investors also then.
True.
So in a way, they're developing the market, which is then getting democratized.
Right. Okay. That's interesting. So, as an extension to what you just mentioned, what do you think would the future of financial accessibility, not just with investments, but possibly also with relation to investor education and the classes that are available? What do you think the future of those things, financial accessibility is like in India, especially with relation to tier two, tier three cities and such?
All right. So I think open banks, neobanks, which are coming up nowadays, they are doing
Right.
wonderful work in terms of enabling access, and that too very efficiently at a mass scale. Like opening a bank account earlier was such a tedious task. Same was opening a FD, etc. A lot of these neobanks, insurance-related startups, they are bringing a lot of awareness in a otherwise very opaque kind of market. I mean, we all know the ULIPs which used to get missold earlier. So a lot of investor awareness is happening that one should not buy a ULIP. Investment should be separate and insurance should be separate as a product category. So a lot of these insurance startups, they are doing wonderful work in spreading this awareness. In terms of normal banking infrastructure of doing transactions, opening accounts, opening FDs, etc. A lot of these neobanks are doing some amazing work there. And of course, in investment part, startups like Wint Wealth, etc., are removing the barriers in terms of accessibility, which were there maybe a few years before.
Right. It's actually very interesting. So just this morning, I'd come across a tweet by someone. I'll probably have a snapshot of that tweet here on the video when I edit it. They basically said that how these newer age companies, we've got Baiju's acquiring Akash, we've got so many other recent newer startups acquiring old legacy companies. So I think that is also what tech has helped us do, because as you said, these neo banks and all.
Yeah. I mean, just recently we saw Bharat Pay acquiring almost a 3-decade-old bank. Imagine a 3-year-old company acquiring a 3-decade-old bank.
Right.
So that's like the power of fintech. And I think lines ultimately will get blurred. There won't be anything finance or tech. It will only be fintech.
I mean, I think it's the natural progression. We've seen especially in India, we've seen fintech as a space just blowing up. So that actually brings me on to the next question. What has it been like in your experience to actually run a fintech company?
Right. So I think there have been pros and cons. In terms of pros, I think the scaling is much easier via fintech model.
Okay.
Because tech does most of the work, so you don't have to hire folks to do a lot of work. Automation, tech automatically brings scale at a huge level. That's the plus side. The negative side is regulations are still catching up.
Okay.
While the industry has moved ahead, regulations are still doing the catch-up work. So we need to engage with the regulators, sensitize them, seek their guidance, etc., of how to get things done. So that I think there are pros and cons of running a fintech, but definitely pros will definitely outweigh the cons which are there.
That's very interesting. One aspect that many people have asked me also is that how exactly are you able to navigate with those regulations? So obviously SEBI is known to be a little stricter, I would say, at least from an observer's point of view. So how does someone new in the space actually approach them? How are those conversations and those discussions like?
All right, so I think it's definitely a time-consuming process. It's not like that straightforward. I mean, we did our first deal in December of last year, but the legwork started a year ahead of that. So for 1 year, we are just figuring out the regulation, the right product, which will comply to all the regulations, etc. So it's not that easy. It will take some time, but yeah, you eventually will figure out a way.
Right. That's very interesting. And the thing is, money management in general, whether you are actually managing actively money, or if you are just acting as a medium, or if you're doing something else, I think it always carries an additional burden or additional responsibility. I think burden would be the wrong word to use, because obviously you are using people's money and you are helping them do something special with them. So does that have, an impact on your thought process?
Yeah, I think that's the most critical thing. If wealth industry per se has been subject to a lot of mis-selling, and at Wint, one of our mission is to make it very transparent. So someone asked me like what our mission is. Our mission is like via Wint Wealth, our investors should be financially well off, financially better off. Be it via products that we are democratizing, the education that we do for our investors. So on LinkedIn, you will see my co-founder Ajinkya. He keeps on writing various investor awareness related posts.
Right.
And that is something which we are looking to productize, so that the education that we are doing for our investors can be substantially scaled up.
Okay.
So I think if there is a platform which is transparent with its customers, not doing any mis-selling, this industry is ready for disruption.
Right. I mean, we're already seeing a disruption thanks to you guys with, such things coming in. But as you said, this mis-selling conception, mis-selling thing has to go, because people still, to this day, on some of my previous videos which are related to insurance and such, they ask me, so do you mean to say insurance is not a good investment? I'm like, those are two separate things.
Yeah. So, I think everyone has been subject to mis-selling of ULIPs, etc.
Yeah.
If not us, our parents would definitely have been.
True. So, transitioning to the next part, all of these things that we discussed. So if you had to say a certain vision for, let's say, Indian fintech companies, or let's say Wint Wealth possibly in specific, then what would that, single vision would be, let's say, for the next 20 years or
so? So like I said, our only mission is like using via Wint Wealth, our investors should be financially well off. So I think it can happen in multiple ways. One is obviously scaling up the products that we are launching. With covered bonds, we are already at almost 100 crore AUM now. The idea is to scale it substantially over next 2-3 years. Then in the pipeline, we have a lot of other products also that we want to democratize. Like we discussed, there are a lot of asset classes which still are available only to institutions or HNIs, ultra HNIs. There is no reason why that should be the case. One should be able to diversify one's portfolio across asset classes.
Right.
Because if you see, like tech has brought in a lot of variables in the market. So one should not have a lot of concentration in just one asset class. You never know what will happen 3 years down the line, and things can like completely change. So diversification in the portfolio should be there. Not only within a particular asset class, but across asset classes also. So you should have gold, debt, equity, covered bonds, securitization, etc.
Right.
So I think that is one thing which will definitely play out. A lot of these non-traditional asset classes will eventually achieve a large scale.
Okay. And I think another thing which is important to talk about is that I believe recently even some US investors and such were saying that, oh wow, look at India. Indian fintech is, really killing it. So do you have any views on that?
I mean, yeah, like India is getting a lot of attention, a lot of capital is flowing in, especially private equity. I mean, the number of unicorns we have seen this year, in spite of this being a pandemic year,
right?
I think it's like mind-boggling.
True.
So that is one thing which is playing out. Indian investors, foreign investors, everyone wants a piece of the Indian fintech pie, because we know this pie will expand and expand like anything.
Right.
So a lot of capital is flowing in, which is good for the ecosystem also. So if you look at maybe a decade back when Flipkart started, the ecosystem wasn't that developed that you could easily raise seed funding or angel funding.
Okay.
But now that's not the case. Even at idea stage, if someone has a good, interesting idea, it's quite easy to go and raise a 1 million seed round, angel round, etc.
Oh.
So that way the ecosystem has been really strengthened with all this capital which is coming in.
Right.
Investors are willing to take the bet because they know if they take 100 bets and just even if one proves to be right, it will make up for those 99 wrong bets because that will be maybe a 1,000 bagger.
True.
It can multiply 1,000 times.
Right.
So that is a lot of capital is flowing in the market, which is helping the ecosystem also.
Okay. I think the part which really struck out to me was that even at an idea stage, people can raise up to $1 million pre-seed and such, that which is just honestly crazy because I think a few years ago, companies that used to raise funding weren't even valued at 1 million sometimes, let alone actually raising 1 million, which is
right.
pretty nuts. And that brings me on to another question that all of these things are changing. We spoke about how fintech as a space is changing, wealth management is changing. We spoke about how assets are also changing. But then the Q&A that I had done on my Instagram and such, the number one question by far in the question category was people asking me about equity related specific things like ICICI Bank, how will it do? Reliance, how will it do? Or just questions like those. So do you have an opinion on that?
That's the trend that we are looking to change. That investment is not only about equity. One should go beyond equity also. I mean, it's almost ironical. Like the last two assets that we did were with entities called as Dhanvarsha and Ugro Capital. Both are listed entities. Investors can invest in their equity shares, which are far riskier compared to their debt.
Right.
But their debt is not available to the investors. It's like extremely ironical. I, as an investor, have access to a riskier asset class, but not to a safer asset class.
True. I think though, if I'm being a little, candid, I think the trend of going for a riskier option is become again, it's a trend at this point because people are also just going like, going for meme stocks, going for just the most absurd cryptocurrencies and such. So I think that trend is possibly there, possibly casual investors just doing it for, as you said, what if this becomes 1,000 bagger or something?
Right.
I think that's very interesting. So that was actually about it for the questions. So do you have any closing remarks on all of this, on perhaps the fintech space, on investing in general?
No. Maybe I'll just leave with a disclaimer that one Wint Wealth products, though we are seeing a lot of traction amongst our investors, but we keep on constantly reminding them that don't park your emergency funds in equities, Wint Wealth, etc. Emergency funds should be parked in your savings account or liquid funds.
Right.
Wint Wealth is definitely not a substitute for FDs or debt mutual funds because, like we initially discussed, the returns are higher, but risks are also higher. So imagine Wint Wealth products are somewhere between equity and debt asset class. So I'll maybe end with that disclaimer.
Right. And any far-reaching statement that perhaps your view on how this landscape might look like 20, 30 years from now?
It's too long a time horizon, Kunal. I think there's so many variables, so much disruption happening. It's difficult to predict what will happen 4 years down the line. Like leave alone 20 years, 30 years. My only hope is the only prediction I'll want to make is, or rather the hope I'll have is 3 months down the line, COVID should not be there.
True. And of course, investors and market participants should be educated, which is, I think, a good common ground between Wint Wealth and myself, because I also try to share all of this so that our listeners, viewers, financial market participants are all educated, because there's a lot of misinformation out there. So with that, thanks a lot for your time. Thanks a lot for coming. It was a nice, good discussion, and busted a lot of myths about investing also today. So let's see. I think our viewers and listeners can ask any questions or something they may have in the comments, and I'll be happy to answer them myself, or I'll possibly reach out to your team or something, and we can do something like that. That
Yeah,
sounds good.
sure. Yeah, sure. No, I think thanks Kunal for having us on the podcast. It was a great discussion, and I hope we were able to educate our listeners.
Definitely. Thanks a lot. Thanks a lot.
Thank you.
Yeah. See you. Take care.